Hit it.
It's Friday, June 18th, 2021, episode 136. I'm Patrick Ceresna.
And I'm Kevin Muir. This week we welcome to the show Phil Schmitt. Phil has a long career on Bay Street as a derivatives trader and hedge fund manager. We have a terrific discussion about the problems with the 60-40 portfolio, active versus passive, ESG, and what he thinks the biggest risk is out there, inflation. Then we're proud to have back on the show Will Thomson from Massif Capital, where he talks about his latest gold pick and the problems with the Chinese nuclear leak.
This is our last week of the shortened show. We'll be back to our normal format next week. There is no history segment this week, but we will settle up our skin in the game bet. So stick around. We got a great show. We are not featuring a beer this week. A terrible thing recording this show sober, right, Kev? But why don't you give us some side effects to Too Much Market Huddle?
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of Too Much Huddle may include the gold miner dropsies, the Powell prophylaxis, I don't know how to say that, or the inflation itches.
I do get inflation itches all the time. Anyway, let's get to the first of our interviews.
It's our pleasure to welcome to the show one of my good old friends, Phil Schmitt. Phil, great for you to be with us today.
Great to be here. Thanks. And thanks for the opportunity, Kev.
I've been looking forward to this for a long time. We've chatted for many, many years. And just before we start, I wanted to tell a story. And it was when we first met, and I was explaining to you how in my job at the bank, I had actually been doing index arbitrage. And when I was doing the index arbitrage, that was, the act of keeping the futures and the stocks in line. I kind of, over the years, I'd come across many different individuals that when they asked me what I do and I explained it, they said, oh, yeah, you know what? I was the first one to do index arbitrage in Canada. And I had gone through this and it literally had happened to me probably 5 times. And I was telling you the story and you said to me, Kev, who were they? And I said, well, Phil, it doesn't matter. He goes, no. You said, I want to know who they are. And I said, well, why? And he says, Phil says, because everyone knows I was the first one.
No, not everybody knew. It was a well-kept secret.
So why don't you tell us a little bit about being the first trader in Canada doing index arbitrage?
Well, it's funny when I think back. So, Kev, you and I have... if I told you my background, you and I would seem to overlap. And the difference in our careers probably is just 8 years. But I define that as 2 trading generations, as in, generally every 4 years you cycle through to somebody new coming in to do whatever you were doing. So index arbitrage, when I did it, was a heart racing, blood pressure through the roof event, which they now give to interns coming off the street. But
it's not making me feel good, Phil. Like the fact that my job has now become for interns.
If I told you what I did, and then what you were doing, just 8 years later, you'd think that the world had changed.
Right. Okay. So why do you walk us through? Because why don't you tell us what index arbitrage is, and walk us through what was happening at that time.
Okay. So way back in 1986, I'm thinking maybe 87. The Toronto Futures Exchange introduced the Toronto 35, or TIPS, the TSE 35. So they created a special index of 35 names that could be arbitraged. So it was an index that could be traded. It had never been in existence before. And what that opened up was the opportunity to trade futures, to arbit. So you had the 3 legs of what any good futures complex requires, which is an arb, speculators, and you have institutional usage. But the ARB wasn't available. I mean, there was really no electronic mechanism. I mean, we had computer automated trading systems called CATs, which Canada was the first to have. But that was one order at a time. So index arbitrage, to answer your question, is you basically keep your future in line with the stock index by, if the future is trading cheap, by buying a cheap future and selling the equivalent basket of 35 names, and vice versa on the sell side. And so index arbitrage, I had to create at the end of the day, I'm a programmer. We can get into that later as to how I came to be on a trading desk. But I had to figure out how to create a program that would create 35 orders, send them down to the exchange, and get them back so I could do the buy, sell, buy the futures and sell the index. And it sounds simple now. You could, go on Interactive Brokers and, a monkey could do it. But back then it was high tech. I won't go into too many details unless you want me to.
No. But it was kind of fascinating. So what? You're confident you were the first?
Yeah. It would be a horse race between me and one other fellow, and I could arm wrestle him down on that.
Sounds good. So why don't you tell us a little bit about your background? How did you come out to be on Bay Street and get into this kind of new world of quant trading?
Yeah. So it's funny. I was back in my teens, maybe even pre-teens, when I somehow came to have an interest in the equity markets. But that didn't manifest in my direction in the sense I went to school and took something completely different. So I'm not trained in business or I'm not trained in economics. And I ended up getting a math degree, which is amusing because I can barely do long form multiplication, but I seem to be good with computers. And so when I went to look for a job,
One second, I'll interrupt here though. Just Phil, you ended up getting a math degree or a computer degree at one of Canada's best schools in terms of right?
Sure, so thanks. But they tell me they didn't get to be a great math school off of my grades.
So for those who don't know, the Waterloo is kind of the Stanford of Canada.
At the time, we would have called ourselves the MIT of Canada.
Okay, the MIT. Sorry.
Yeah. I came out with a computer background, and I did focus on the industry then. And literally, there were only two computer programming jobs available on Bay Street in 1980. Okay, sorry, I have to stop now. I've been worried about saying that since you told me that I'd have an opportunity to speak here. As soon as I say 1980, I lose half your audience.
No. They want to know what it was like when we had to walk to school with chest up to our, chest and things like that.
Now, half your audience just went on pause and said, "Boomer." Okay, so I came on 1980. Oddly enough, the industry was highly technologically advanced in terms of telecommunications, but not computers. And literally, there were only two programming jobs. I got one of them. And it was at Wood Gundy. And literally from 1980 through to 1995, my career was basically trying to figure out a way to use a computer in some part of the investment industry where it had not yet been utilized. And so I started at Gundy, but I was just in the computer department. But eventually I moved to Burns Fry in the research group as the quantitative analyst. But that was it. I mean, we didn't even call it quantitative analyst. It was called operations research at the time, which meant nothing to anybody. And then, so a gentleman on the trade desk who later became my partner said, listen, took me out of research and put me on the trade desk. And, Kev, you've said in the past that your job description was, you're not the best programmer, you're not the best trader, but you're the best programming trader I've got. Yeah. My job description was, we don't know what you're doing or what you can do. Just sit down, shut up, and figure it out. And really nothing. It was crazy. It was nothing for me to do. And then the Toronto 35 came along. And that got me into the world of derivatives, got me into the world of figuring out electronic trading. We did the first indexed arbitrage. Burns Fry, the group I was with, did the first indexed basket trade, which was as frightening and perilous as that silly little indexed arbitrage that I did a few months prior to. We did a lot of new and interesting and innovative things. And I did that for a while, and then there was a bit of a management reshuffle at Burns, and I didn't like where I was going to end up. So I took the opportunity to step out and join TD. TD this is well before Newcrest, before they got into the equity business. And so I was the equity guy. My title at TD was ridiculous. My title was Director of Equity and Derivative Trading. Right? And I never traded a derivative. They weren't able to trade derivatives.
Right.
Great title. Anyways, that lasted a year. And then I was waiting for my partner to set up a hedge fund. And once he had and got it running, and I knew he couldn't do it on his own, I joined him and was in the hedge fund world in 1992. We managed a multi-strategy hedge fund from then, and I left that in 2005, and I've been on my own. And my penance is that I gravitate towards doing things that are new. I'm not interested in what everybody else is doing, but my penalty for doing that is I generally leave too soon too. So I'm always trying to find something new, but then I don't stick around to reap the rewards.
I'd love to kind of dive into your time at the hedge fund. And that's when I knew you, because you were actually one of our clients. And you were at the forefront in terms of Canada creating a multi-strat hedge fund. And not only that, being at the forefront and being kind of a leader and stuff, you had periods where you experienced some growing pains and some hiccups, and specifically the long-term capital. Why don't you walk us through, what you learned creating that hedge fund, what happened, maybe what you do differently. Just kind of give us some flavor of what it was like back then.
Yeah, it was. I'd love to. It makes me go back, so I have to push out some cobwebs. The 1992 was a great time. So it was early days. We weren't first at anything. The industry was defined in the U.S., but it was really early days, and it really was the classic two guys in a Bloomberg starting up, and there was no business to it. There's now a business in hedge funds. You're a fund manager, but you're also a business manager. Back then, it really wasn't the case. Generally, I'm going to generalize now. From 1992 to where we are now, I've seen three shifts to the hedge fund world. I'd say the first, what we were trading initially, which are all the arbitrage strategies. So we were primarily convertible arbitrage managers. As most hedge funds, the pioneers, their DNA is converts. So we did convert arb, merger arb, volatility arb, restructuring, on and on and on. Back in those days, the hedge fund industry survived just because of gross mispricing of securities. We were trading converts when nobody wanted to trade converts. As another example, bringing it to current date, we were trading SPACs when they first reemerged in 2004. Remember, Jamie told the story that they were in existence prior to, but had been discredited. But then when they resurged in 2004, we were trading those. And again, because the ARB wasn't well understood and there weren't many players. So that was the kind of thing. We were always looking for something that was mispriced. That was the first stage of hedge funds. And then what that gravitated towards as more money came in was it became less about gross price mispricing and more about structural arbitrage. So that's when you started hearing about statistical arbitrage, which was always, I think, mislabeled. Really what they were doing was just scalping for eights because the market was still trading in eights at the time. And then when they traded to nickels and pennies, they were just basically back office, way more efficient in terms of the back office processing. That's where their margins came from. But so structural arbitrage then moved to where I think we are now, which is basically complexity. If you're not trading complexity, you're basically just grinding away and picking pockets from other people. You might have alpha this month, but you're giving it up to somebody else the next month. So it's been fun to be involved in the industry as it's gone through these three changes.
What do you mean by complexity when you say you're trading complexity?
If you look at a global macro hedge fund these days, it is unbelievable what they're trading and how they're trading it. The complexity that's built into their portfolios, the lines, the individual positions, the structuring, etc. It's just, I don't think that there's any margin left in just long short equity, right? Buying cheap, selling rich, buying growth, selling value, something, whatever. I think that's a mug's game.
Right.
But the funds I would gravitate towards are the ones who are finding the structural arbitrage through the trading the complexity. An example of that is, and it's been talked about on your show often, is structuring desks often create misalignment because they're just natural sellers of all. Well, the hedge fund world will figure out how to be the buyer of the vol.
I see what you're saying. And then they figure out the ways to hedge that off becomes increasingly complex.
Yeah.
Because it's not
a typical portfolio not typical, I shouldn't say that. I'm aware of portfolios that would have thousands of lines in it. It's not 100 names, 50 long, 50 short.
Right. It's all sorts of different pieces that they're trying to, hedge it out. And that's what you mean by the complexity. And so it's no longer two guys at the Bloomberg can't compete.
No.
Right. And that's okay. No. So one of the stories that I love to hear, though, is that your long-term capital story in terms of you guys got caught up in the downdraft and you had expanded into some credit trades. I'm a big believer that you learn from your mistakes. I think it would be great to hear what happened there and maybe help us all avoid that in the future.
Sure. Yeah, let's all avoid that. Absolutely.
Well, to be fair, I feel like it's scarred you. Anytime I talk to you about credit trades, you're like, nope, 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 nope. I don't.
Yeah, no, if I've had two of my biggest investment mistakes, they've both been on the credit side, which could be as simple as saying keep the equity guys away from credit. Let me lead up. So we started the fund in literally 91. I joined in 92, so I missed the start of the fund by about 3 months. 92 was a good year. 93 was a shakeout, unbelievable year, silly, good year. And then 94 was 5, 6, and 7 were just normal hedge fund years. 94 was people should stop and think about 1994. If you look at equity markets in 94, there was nothing spectacular happening. But the bond market was down 25 points.
Yeah.
Right. So
there was a huge, that was the original taper tantrum or whatever. Yeah.
Or no, it was Greenspan raising rates.
Right. Okay. But it was,
notice.
Right.
So take a 50% weight in equities and drift it by 25 points. It was an ugly year. Anyways, we got through that, 94, 5, 6, and then 97, 8 happened. And by this point in time, we think we're pretty hot shit and we're trading well and we've got a bit of a flow going and business going. And volatility was high, so there's lots of things we could do. And around August, we realized that the world was changing under us and we weren't ahead of it. We'd also expanded from just myself and Paul to another manager and picked up a research person and picked up other strategies. We realized that we were going to grow our asset base. We had to have more capital employed, and more capital employed meant more strategies. So we were picking up a vol trader here, and eventually we found that the world of credit was an opportunity. So we hired a credit guy, and the trade, again, we were two equity guys, so we should have known better, but didn't, was long credit, short treasuries.
Okay.
Horrible trade now in hindsight.
Yeah.
And we got caught up in the liquidity squeeze, the Asian currency crisis, which led to the long-term capital volatility crisis. And we found out that we had many of the same types of positions that LTCM had in the States.
Right.
They were long credit, short treasuries. They had lots of things going on, but they also had a vol trade on.
Yeah. You name it. There was a risk they had it on.
Yeah, exactly. And so we realized in August we were in trouble, and then it escalated towards September when we were fighting for our lives. And it was an interesting exercise to go through, awful in every manner, personally, professionally, financially. And, we were stewards of people's money, and we were, if I can say it, we were fucking up. So, you'd go in and you'd work the day and you'd work hard and you keep your head up because you had people who were looking up to you for leadership and guidance. And you'd go home and just, thank God you had a dog around. So somebody was nice to you.
I thought you were going to say to kick. I thought you were going to be like, I thought it was going to take a dark turn there. I'm glad that you said it the other way.
The irony is I didn't have a dog. Don't have a dog. So no. But it was staying ahead of the margin call. I mean, we were being liquidated and we were liquidating ourselves. There was no liquidity in the market. The corporate bond world, I found out is just a mug's game. It's a beautiful game. Like I have all kinds of respect for corporate traders, but it is, you wouldn't want to go to a bar fight with a corporate trader. That's what I learned. And just as an aside, we traded a lot of things in a lot of places. And there were 3 places where I knew I was going to get bent over and beat up. And one was the LME. One was the NYMEX, and the other one is corporate bond traders. And the difference is the LME, they would take advantage of you, but you'd want to have a pint with them afterwards.
That's right. They were nice. They were British about it.
Yeah. And the NYMEX, they were just, chew you up, spit you out, and they didn't ask for your number afterwards. But the corporate bond guys, they were just brutal. They were just brutal. So I'll give you an example. So we had a liquid. The point is that it was a big margin call. We were offside. We had a levered portfolio, as was hedge funds were inclined to have. We were over levered. Most of our strategies were fine. I break even to some of them were way positive. we had mark-to-market hits all over the place, but you knew that long-term positions were good, but we didn't have the opportunity to hold the positions because we had this credit strategy, which was imperiled. And although it was maybe, I'm making numbers up off the top of my head, it might have been 20% of our capital, we zeroed it. So when 20% of your capital gets zeroed, everything in the portfolio goes.
Right.
And you're just selling anything you can sell.
Right. And when this is what people don't realize when this happens, like, and this just wasn't just you, it was everybody. It was across the board, everywhere. All hedge funds were experiencing, not all, but almost all hedge funds were experiencing the same thing. It was like a global margin call.
Yeah, 100%. And we weren't the cause of it, the catalyst. We were just caught up in the drift. But the reaction has to be the same. You got to stay alive, stay afloat. We only had one prime broker at the time because it wasn't common to have more than one. And they worked well with us, and we worked well with them. And the game was, we had to give them as much information and stay ahead of the information flow. And we'd haul our ass over to their office twice a week, sit down, go through the positions. And the rule of thumb was, he said, I have to liquidate you if you let this happen. X. If you hit this lower bar, I have to gun you.
Right.
So our job was to just all the time stay ahead of him. He said, if you stay ahead of me, I can even buy you some time by telling him that you had good intent. But if you get behind, you're out.
Right. So if you're out, then the last thing you want is them selling it, because as bad as it is for you, it's even worse when they do it, they do it themselves.
No. And I hear people talk about when they've been margined out and they whine and they complain, but it's the rules of engagement. We all knew it, right? Everybody knows about it. You can't whine. Yeah. But we got through it. It was brutal. We had a public vehicle at the time, so unfortunately we got through it, but it was also publicly exposed. It was tough.
Yeah. And did you end up you ended up selling by the end the whole portfolio, right? Some big is that not how it, pardon?
I didn't know you knew that.
Oh yeah. So I guess the world knows now. Do you want to not talk about it?
No, it need not be a secret. Yeah, so the entire time you're doing everything. You're trying everything you can. And like my partner he was a business came from a business school. So we thought maybe we could package it up and sell it as a CDO. Well, of course, that's ridiculous. Who's going to bid on that? He smells blood in the water. But we tried everything. Like we were. There wasn't a single stone that we didn't turn over. But at the end of the day, we had the runts left in the portfolio, and we went out looking for bids. And we found some shop in the States I've never heard of, and have never heard of since. And they gave us a stink bid, and it was awful. And then we didn't hit it. And then they gave us a lower bid, and you know how that goes. You can I won't go through that. Eventually, we held our nose and said sold. And we didn't bottom ticket, but we were within, I don't know, I'm going to guess a week and a half, 2 weeks of bottom.
Yeah. And that's kind of like when long-term capital experienced the same thing, right? They were out and Buffett was bidding them and they had lots of chances to get out.
Yeah. I'll tell you, I read When Genius Failed afterwards, of course, and like in my bed with the covers over my head weeping, but thinking of just how stupid we were and how many other people were likewise. Silly,
right.
Stupid.
And listen, I don't, you're being very gracious and talking about your mistakes, but the reality is that there's almost every hedge fund manager in the world during that period had a very similar story. And the only question was how bad it was. And you guys bounced and it was terrific. So let's get on a little more now about,
Kev, can I interrupt you once?
Yeah, sure.
I apologize because there's one final story. Corporate bonds, and it involves your old shop. This is how bad it was. We had an Air Canada position. We were long short Air Canadas, right? Yeah. And so this wasn't a corporate against treasuries. This was basis, corporate against corporate. I lost on both sides, right? And it was your DS guys who wouldn't let me cover the short. Offered it 05. How much?
You know what? I'm really shocked. There's such nice guys there. I'm really shocked. They don't just, put in the screws. That's very shocking. I'm really surprised. I'm really surprised at that.
But that's how bad it was. You could lose on both sides of your trade.
Yeah. Okay.
Sorry, Kev, I interrupted you.
No problem. It's I'm always love hearing a story about my old shop, about them being such stand up, fellas. Okay, so let's get on. One of the things that I like about you, Phil, is that you have a very, very, let's just say, historic perspective when you talk about the markets, and you have some unique kind of insights about how they work. And one of the things that you've been very concerned about recently has been inflation. You've been pounding the drum way before it got kind of cool to do so. I would love to hear why you think that inflation is the real worry and what we're doing wrong in terms of the average investor / portfolio manager.
Right. Oh, thanks. One thing to preface this is I'd say out of all the things I've done, I've developed a bunch of, I don't know, maybe skills. Some I'm good at, some I'm only okay at. But one of the things I think I've been constantly solid on throughout is understanding market structure. And eventually what that leads you to is macro. And when you start thinking in a macro context, I think you have to have a historical context. Like, I don't think there is such a thing as a young macro trader, because you have to have experience to come to understand how the pieces fit together and can change. So eventually that led me to macro. And eventually when it leads you to macro and you take a historical perspective, I see inflation. And my starting point is I if at the end of this you ask what my books are, one of the books that I like, one of the books was Lords of Finance, and reason is it talks about the central banks really through World War I onwards, and you see the development. And I think the position that we're in right now is predicated. I'm going to type myself as soon as I say this. We're in the situation that we're in right now because of 1971, when we went off the gold standard and became a fiat world. What are you laughing at?
You're like that. You're like that guy Lou Manheim on Wall Street. Well, you know the movie. I don't know if you remember. He's busy telling Bud Fox that the whole world went to hell when Nixon went off the gold standard. That's like you, Phil.
Yeah. But I use that as a starting point, but it's only because it's within current modern history. But I think 71 only came about because of 45, Bretton Woods, and 45 only came about because the Treaty of Versailles. And Treaty of Versailles only came about, and I can go on and on and on and on. So I think there's a continuum, and we're on this continuum that we're on now because of 71. And like literally, I can start in 21 and create the same story. I use 71 because of the context. And I don't think we'll deviate from this road until something, and I don't think I need to come to a conclusion other than between here and something will be inflation. I'll use one example. You've been very good at detailing your journey of understanding MMT. And it's not that you advocate or are disinclined to use it, but just you want to understand it. Well, my preface of MMT is I don't care what you call it. We're heading that way anyways. It can be called MMT. It can be called 1.9 stimulus. It can be called 6 trillion stimulus. But we're heading that way only because there's no alternative, and being fiat allows it to happen.
Right.
So let me pause just in case.
Okay. Well, could you explain when you say continuum? I would think that that's one of the things that makes you different than a lot of other thinkers out there. Why don't you explain what you mean with that?
Well, the continuum is 1945 leads to 71, 71 leads to where we are now. And again, I'm not sure I'll directly answer your question, but this world of fiat is unprecedented, right? I don't think people understand the significance of that. And you can look back and say, sure, we've been in this world for 50 years and nothing bad's happened yet. And that's fine. And I don't disagree with that. But what I don't think you can look at historical context and understand where we're going, because this is literally unprecedented, but for one minor technical historical period. And the continuum is, I think, 1971, nobody understood the power of limitlessness ability to expand central balance sheets. It was really 2008 when the response was quantitative easing, which was an appropriate and necessary response at the time. But I think that was an eye opener where the kind of went, wow, look at this.
Right.
Look at this new thing. And it wasn't even new, right? It's been done before. But that you don't get to do the continuum is that, geez, that worked. And they did two QE1, 2, and QE infinity. And then you come around to the pandemic. And also you throw in 1.9 trillion. Isn't that the number? What have we spent in COVID so far?
Oh, I think it's more. I don't
Yeah.
know. It's a
But I
lot,
guess the
though.
1.9 trillion was the stimulus package that was announced in March by President
Yeah.
Biden. I mean, you couldn't have done that. Like in 1984. Well, think about what Greenspan did to protect against the crisis of a potential risk of Y2K when he liquidated and expanded the balance sheet.
I
I
know
mean,
it's so much. It's hilarious when you go and you look at the
yeah,
Fed's balance sheet, and that caused this huge bubble, and it was this tiny little,
yeah.
kind of thing.
And it's a short rope to tie that to the tech bubble and collapse.
Okay.
So what I
wait,
say by continue is that we're on this road. Sorry.
So, question for you then is, you sketch out this continuum. You tell us how inflation is the inevitable result or destination that we're headed to. Yet we continue to have a lack of inflation, and even now, like we had this situation where everyone got excited about it. And now it looks like, oh no, that was just yet another false alarm.
Yeah, it was a bad week for to be an inflationist.
It sure was, buddy. It sure was.
Yeah, I laugh, but I'm not really laughing. Yeah, listen, I don't need to time it. This is the funny thing about the difference between me. Because I'm not an economist, I don't need to type it. I don't need to time it. I think if I position for it, and I can position for it, and we'll come to what I think an appropriate portfolio is, I can still earn returns and yet be properly positioned for inflation. It just means I'm going to give up. The equity markets last year were up some ridiculous. Equity markets last year were up 18.5%. Well, I'm never going to participate in that fully, but I'm fine with that. I don't have the risk that 60-40 portfolio would have either. I think I'm off the question. What was your question?
Well, so why have we not seen inflation? And what makes you so sure that is the end result? I guess is another way of phrasing it.
Okay, so sure. So why not the deflationist? I know that you pick on Patrick from time to time, the deflationist versus the inflationist, and I can see both sides of that argument. I am short-term deflationist, mid to long-term inflationist. So I think we're going to continue down this. The debt load is crippling the technology. I accept that argument. Except I think that the money growth, I don't care how you define it, be it the central bank expansion, be it real, growth in M2, all that has only ever ended in inflation. There is no reset. There's no capital market solution to this extended debt scenario and oversupply of liquidity. It doesn't end with a nice tight capital market solution.
And
So
is that
what makes me Kevin? What makes me say that? History.
okay? So explain that response.
Well, anytime when you have a tangible currency, so gold backed or any commodity backed, if you run into a situation where you have to devalue in order to something economically at the sovereign level gets out of whack, traditionally you'd come off the gold standard and devalue, reset, and come back on. That played out over a 10-year period of time usually. You don't have that ability now, right? There is no coming off and going on. Oh, sorry, Kev, I lost my train of thought already.
Oh no, it's okay. But so, in terms of this inevitability of inflation, I really want to go down this road because I think a lot of people would say, us inflationists have been calling for this a long time. That's just that, what's to stop us from having a Japan for another 10, 20, 30 years? And I'm always curious because I think that one of the things that when we've spoken in the past that you've highlighted is also the possibility of this creating wars. And I don't want to make you sound alarmist and things like that, but I think you definitely have more of a historical bend than I do, and that you definitely think that the current path that we're on is creating more friction in societies than I would say. Like I'd be the first to admit that we are that the current path creates friction. I kind of push back to the idea that we need a war to fix it. Whereas sometimes we've chatted and you've said that that's the end result. That's a very easy conclusion to draw.
Yeah. Okay, great. Thanks for getting me back on track. Japan's an interesting scenario, and Japan confuses me. And I've listened to every side of both sides of the Japan story, and the bug on the windshield scenario would have been an obvious conclusion, and the fact that they've escaped that muddies every argument.
Okay.
So it is a phenomenon, but I think Japan is an example of the fact that this can continue on a long time, before inflation finally gets realized. And the whole discussion now about
going to war.
Sorry,
do you think that this will eventually cause? Do you think that? Okay, let's just start with this. Do you think it's causing friction in society?
Okay. Yes. Okay. Everybody, when we talk about inflation, there's a tendency to default to price inflation.
Right.
And yet I think that's too narrow-minded. We clearly have an asset inflation issue. There are multiple kinds of inflation. Each inflation type has a cycle. Has the asset inflation created friction in society? Absolutely. So let's say we gravitate away from asset inflation. We do finally somehow see price inflation, be it wholesale prices. I don't know how you can not say we've had wholesale price inflation. But that's another type of inflation, which eventually translates into price inflation, which is what everybody's pegged to, and which all the tips and real return bonds are pegged to, is price inflation.
Okay.
So I think that's an inevitability as you get to that. Now, to your question about how does this lead to societal friction, it's not intra-societal friction, it's external. I know you in the past, I think I have to factor geopolitics into my analysis. You have said you don't think there's value to that. And I agree from a trading perspective. I'm not trading, I'm positioning. So we have a different time frame on that.
Okay.
But I think geopolitics, if I define it, is protecting your resources. As in, if I can trade from here to there, I need to keep that trade line open. If I can't, then I have to protect it. And I think what happens is everybody is motivated these days to have a cheaper currency. And this is where geopolitics come into it, because currency is the only, I think, pure variable in the capital market system right now.
Okay, why do you feel that?
Okay. We should, and we're all trained to spend all of our time focused on the risk-free rate of return, right?
Okay.
Every capital market model has risk-free rate of return as its base. And off of that, you build the risk premium.
Right.
Except if the risk-free rate of return is contrived, it's not market-derived, then you can no longer trust that for your risk premium. So I think risk currently built off the RFR is misstated. And so if you don't trust that, where do you go looking for a market-derived variable? And it's the currency market. And when you start taking a look at the currency market, you start getting into externalities, like one country's position versus another country's position. And everybody is motivated to have a cheaper currency. Not everybody can. If you look at the Paris Accord in '82, classic example, where for one reason or another, understandable reasons, the U.S. dollar is appreciated, and it's become enough of a political issue that we rallied together all of our friends. Sorry, I keep saying our, but I'm not American. But the Americans rallied together all their colleagues and sat around the table and said, U.S. dollars has to go lower. Who's taking it? And Japan did.
Okay.
Right?
Yeah.
That just is an easy example of the give and take that has to happen in the currency world. Now, I think I don't need to. Yeah, I have a professional opinion, an investor position, and then I have a personal opinion. My investor position, if I'm working on my own behalf or if I'm working with investors, only takes me up to the inflation side. I don't need to resolve the end of the inflation cycle. It happens that the portfolio I think is appropriate for inflationary environment happens to be appropriate for turmoil. So personally, I have a view on how this geopolitically extends itself, but it need not factor into my investment portfolio.
because you think that inflation will be the end result, and that we will even, regardless if the currency ends up being the mechanism upon which we fight this battle, it will result in inflation. Is that correct?
Correct. Yeah.
And so, currencies have been actually remarkably quiet. Do you have any insights in terms of why that is? Why we've gotten to this point where it hasn't become a bigger deal? Like, let's face it, back in the day, currencies were what all the macro traders, focused on. And it's been a long time since currency has been at the forefront of macro trading.
Yeah. Here's an interesting observation to your point. You're right. Macro guys have been focused on rates for so long. And within the last 12 months, I won't be any more specific than that, I saw VAR rotating out of rate risk into currency risk at a faster pace.
Oh,
and recently it's reversed.
Interesting.
Yeah, so people were picking up on the fact that if there's nothing happening in the rate market and there's stuff happening in the currency markets, but that's reversed. So why not? Because it's schoolyard rules where there's no reason to pick a fight if there's no reason to pick a fight. You don't pick a fight if there's no reason, if there's no advantage. Nobody is currently, again, my definition of geopolitics is protecting your resources, your access to resources also. There really isn't anybody fighting. People are pushing boundaries, but there's really nobody instigating anything. There's no need to yet.
There's nobody pushing it in terms of getting their currencies to levels where they're stealing what is viewed as more than their share.
I'll use a more specific example.
Okay.
But, the South China Seas and Taiwan, right? Those are hot spots. I think Taiwan is, I've said this for a long time. I was going to say decades, but maybe not. I think it's a linchpin in the future system, but there's no point in anybody putting Taiwan into play right now. South China Seas are contentious, but they're not blocked. Russia is trying to expand their eastern boundary, but with kind of half-heartedly. More is just kind of be a bully on the playground mode right now. That could change. But what I'm saying is there's not enough of a friction for somebody to push over a limit.
There's not enough an upside. There's just no point in doing it. And so what changes then? Is it economic stress?
Well, eventually, again, I tie it back to fiat. The problem with fiat is it's completely built on trust, right? A dollar is only worth a dollar because yesterday it was, and today I say it is, and tomorrow it will be again. Somebody's going to call that bluff one day. And I don't mean the US dollar specifically, but somebody's going to call out fiat. And if you look back historically, the last two times it's happened, it's been France and Switzerland. I'm not suggesting that they're going to be the ones next time, but they're the ones who called the U.S. out on the debt burden from the Vietnam War and said, "Give me the gold."
Right?
You say you're good for gold. Give me the gold. Right. So somebody's going to call somebody out sometime. So if the U.S. and I'm not going to go into GDP ratios, debt to GDP ratios, et cetera, et cetera. I don't think everybody's going to call Japan out, but one day somebody's going to call somebody out.
And so do you think it'll manifest itself with a race to gold like in the past?
Well, that's a great question. I do. I don't mean to be a traditionalist. I know Bitcoin has a role. You're
allowed to talk about the asset that shall not be named. Yes, you are.
But I will take the responsibility for invoking that name.
Okay.
Bitcoin is a new kid on the block, and it has an interesting role to play. When I type what its role could be, is and could be versus gold's role has been and could be, I'll pick gold in the fight versus Bitcoin.
Yeah.
I think somebody will eventually, and it'll be China. Sorry, skipping to the end of the story. Will eventually come out with a gold-backed currency, not to be a reserve currency. China has never played a game where they've wanted dominance. They just don't. This is, again, controlling the game board. They don't want somebody else to control the board, which the reserve currency right now does.
Interesting.
So I think they gain advantage by creating a tangible to an intangible.
Fair enough. Okay, so why don't you talk to us about your portfolio that you have kind of thought through as an alternative to the typical 60-40 portfolio that has kind of prevailed through our industry?
Sure. So I have a thesis that the 60-40 is just not only inappropriate for an inflationary environment, it's probably there's a lack of impetus to change because the 60-40 portfolio suits the industry's needs, which is we are an industry that provides products and services, and 60-40 is a beautiful vehicle for selling products and services. And I think in an inflationary environment, it will cripple people's investment portfolios. So I think the industry has to see 60-40 is not appropriate for an inflationary perspective, which is really me saying the industry has to change, which is unlikely to happen. But nonetheless, I start that message today, I guess. So the 60-40 portfolio, lots of people have discussed this. Oddly enough, I find that they don't offer a solution. They debunk 60-40, but don't tell you what to do.
That's right.
So,
Listen, it makes better copy to just, say how bad it is without any solution. It's like all of FinTwit usually.
Okay, so 60 equities are going to get trashed because the duration aspect of growth and trend has been dominant in the industry. So 60 is not going to survive well in an environment where duration gets chopped. 40 fixed income doesn't work because you don't want to be in a fixed income portfolio when rates are rising. So you got to cut that out. So what I say is your 40 weight has to be reduced and move it from fixed to floating. Anything that's floating. And there's lots of floating things out there. You and I love TIPS and other nationalized inflation-protected bonds.
Right.
Preferred shares, floating rate bonds. You can take your fixed portfolio, swap it to floating through the swap market. But I think you've got to have adjustable. And the funny thing is, when I say that, my strategy doesn't disavow earning income. It's just that I'm earning floating income.
Right.
So my portfolio still has an income component to it. The 60 weight in equity has to be dramatically reduced. And you have to realize that equities have a very complex relationship with inflation. There are sectors you have to figure out what type of inflation you have, where you are in the inflation cycle, and some sectors are good at appropriate times in different types of inflation. So it becomes very much an active management process. You just have to constantly be working through. Utilities are a great start to an inflation cycle because their ROEs are indexed to inflation. Multi-unit residential real estate's great because it has adjustable income, et cetera, et cetera. So you freed up some capital from your 60, freed up some from your 40. So, classically you move it into real assets. So real assets, it's well defined. I'm not saying anything new here. Commodities, buy farm equipment because everybody needs to buy a tractor today because the tractor is going to be more expensive tomorrow. So buy big CapEx items, on and on. There's lots of ways to get real assets. I also think I have this video which talks about the phase change, that as you move from disinflation to inflation, it has all the chaos that's associated with phase changes. And I want to be in the alternative portfolios, alternative hedge fund managers who will trade through that chaos in whatever form. I'm not a big fan of volatility traders, but I am a big fan of macro traders.
Okay. So what do you explain to people what you mean about the phase change and why at first blush you might think, oh, vol is a great thing to own if there's going to be some little bit of changes. Explain to us why during that phase change you think that macro beats vol.
Well, when I say phase change, I don't think anybody's going to say, well, oddly enough, gentlemen like Russell I apologize, I never get his name
Napier, right. I think it's Napier.
Yeah, thanks. He did a change, but not everybody's going to go black to white overnight. But you're going to move from disinflation to neutral to inflation. And I think that neutral to inflation is going to be chaotic because I think it requires a portfolio adjustment. And once you start rotating through your portfolio, you'll be a seller of bonds and you're a buyer of floating rate. That there's great chaos in the markets created from that. Great opportunity.
Right.
The macro guys are dialed into that space.
Okay.
Right.
I get it.
And so hence I like the macro. And I'm not just focused on macro guys, but I'm not focused on long short equities. some of the classic strategies.
Right. And so when you saw this, I guess I think we could agree that there's been the start of that phase change. And was that just, would you argue that was just the very tip of it? And that really, when you look at the long-term big money, that it really never even changed out of their previous stance and more towards inflation?
Yeah, the macro guys I know and watch.
No, not the macro guys, like the long-term money, like the pension funds and the endowments and things like that. Because I've heard like the argument. I have a good buddy, and he says, listen, we haven't even seen the start of this yet, because the reality is that they have to go get consultants, and then they have to go to their boards and things like that. And so even though all of us traders have already gone from inflation is on, great, buy everything, and now inflation is off, sell everything, the reality is that the endowments never changed.
No. So if I think about model portfolios, there's the 60-40. There's the Canadian pension plan model, which I just reference as Canadian pension plans because they have a very specific model. Sorry, what did I say? So 60-40 pensions, there's endowments, and there's single family or family offices.
Yeah.
All of them have different constructs. And what I'm talking about is a blend of the pension, a blend of the family office, and a blend of the endowment model. But the pension plans have way too much, in my humble opinion, and they have different objectives than me. So I'm not saying that it's inappropriate, but they have way more equity weight than I would ever want to tolerate currently. They have to. They have a massive long liability duration, so they have to have an equity play.
Right. They have no choice. Otherwise, if they don't, they have to bring down their assumptions.
Right. And the classic endowment model has way too much private equity as well, for my taste, only because the historical performance has been extraordinary.
Right. And listen, really, private equity is just harvesting the illiquidity premium of equity. Right.
Well, listen, I can go on a rant about private equity.
And we'll save it for another day, because I got still other things we got to talk about. So continue on.
I think the last piece of the portfolio then is cash. I carry a ridiculously large position. Sorry, I was going to go on another tangent, but of cash, and I think cash is just an opportunity option with yields as low as they are. I'll pay the 50 basis points to hold. I'll pay away the opportunity to earn 50 basis points to maintain a cash position to be flexible.
Right. So it's almost, to some extent, it's a much more defensive portfolio, your kind of switch. And your argument is that, you should be playing defense now, because we're about to get this inflation. We're about to get all this change. And everyone's doing the exact opposite. In fact, they're, increasing their equity risk. They're buying more bonds because the reality is that yields are lower, and they're doing it at the wrong time.
Yeah. Listen, one of the things I was going to talk about is I understand why people are extending out the liquidity curve and extending out the equity risk, et cetera, et cetera. I'm going to use it. Can I reference Die Hard? Everything.
Yeah, sure. Everyone loves Die Hard. Yeah.
Okay.
The Nakatomi Hotel, or whatever it is.
Die Hard 2 is Die Harder.
Okay.
So the storyline is the protagonists want to show the seriousness of their intent. They've taken over air traffic control at Washington Dulles Airport, and they're going to crash an airliner. And they do that by taking the instrument settings and dialing it 200 feet below sea level.
Okay.
And so what happens is the guy up in the plane, the person up in the plane thinks he's landing, and he still has 200 feet, and he bounces off the tarmac.
Okay.
Kaboom. I think the risk-free rate of return currently is dialed 200 feet below sea level. And so all risk premium is falsely stated. So everybody's talking about you've got to go in the equity market because the equity risk premium is so high. And it is, except I don't trust the base level.
Right. That's a great line. I had forgotten Die Hard 2.
That's a good one.
That's an old school one. Okay, listen, you've touched a little bit on the need to be active, and you've had some big kind of great views in terms of the active versus passive debate, and the fact that many people are missing what you think is the actual real important kind of thing that people should be looking at. Why don't you tell us what that is?
Okay. So, and I'll establish the fact that I think I have legitimate bona fides to make this point, because I was an index fund manager between that time I was at Burns and the time I went to the hedge fund. I managed an index fund way back in 1991, and I was what you would call an active indexer versus those who just do the index changes on the close of the
Right.
day of trading.
Okay.
The reason being is we were looking for mandates. So if you're an index fund manager, you have to show zero tracking error, and the only way you can show zero tracking error is if you trade the index changes.
Right.
And
Because
so
there's a cost of running your business and things like that. So
you can't win a
yeah.
you can maybe win a mandate at that time. Things have changed. At that time, you could be down 5 basis points to the index, or maybe up 10. But you couldn't, if you showed up 25, people wouldn't give you a mandate because they say you're tilting somewhere. You're not an index. So that was your range.
Yeah.
So I traded the index changes to try and gain an advantage and earn back the transaction costs. So the other day, Tesla happens. Oh, and I did this as an indexer. We then did it at the hedge fund I was at. And then when I stopped working at the hedge fund, I still did it on my own for a period of time until I realized I was being outmatched every which way. But then Tesla came about.
Yeah.
And so I thought, well, I'll take half an hour to see if I can figure this out. And it was fascinating. So I did the Tesla trade. Not just on the Tesla side, but I also care about what's going out. There was something coming out, which when I look back at it, the volume spiked on the Monday, Tuesday. And if people fact check my story, they're going to realize that whatever was coming out, AVI, whatever that is, was there was a restructuring event. So the restructuring happened on the Monday, the Tuesday of the index change. So a lot of that volume, but even if you back that volume out, you come to the realization that the indexers are not trading the volume from Monday, Tuesday, Wednesday, right? Who's trading that volume? If it's not the active indexers and it's not the passive indexers, and somebody's trading this name, it's closet indexers.
Yes.
So they live under the guise of being active managers, but they're not really active managers. They're closet indexers. Yeah. So this whole passive active debate, I think, is mispointed. So also, I should reference the fact that back in 1991, I was fighting the same fight, active versus passive. So this isn't a new argument.
Right.
What it is a much better articulated argument than it used to be in the days gone by.
Right. Oh, no, you're absolutely right. People think this is new and that Mike Green's things are, this revolutionary idea. The people have been arguing about this for the moment that indexing came to be.
Yeah, so I think there's a strong point to every argument and there's a weak point. And I can't say that the points they're making aren't accurate. They are. They're factually correct. They're technically correct. They're structurally correct. I think it's a weak argument they're making. The stronger argument is it's not the passive guys. If you look at active management AUM versus passive AUM, it's dwarfed by active. And if you then take the closet indexers, it's a huge percentage. So don't blame the passive guys. Blame the guys who are hugging an index. So then you have to ask the question, why is that a problem? Well, it's a problem because the reason why you hug an index is a business reason as much as it is an investment reason, because you're going to lose your assets if you underperform the index over a period of time and you keep reporting to your clients, I know the index went up 15%, you only we're up 10.
Right.
So the industry is highly motivated to provide indexed-like performance.
Yeah. And it doesn't, you almost can't go and not buy Tesla. Like, and I'll give you an example. I have one of my good buddies manages U.S. money for, I think it was an insurance company. And I remember him telling me that, like, basically his starting point is the S&P 500. And if he doesn't have a view on something, he just has the position on market weight. So the reality is that all of his bets are just kind of these little at the margin tweaks that he does, because he doesn't want to go in for that company. It's a bigger deal to be down 500 basis points than to be up 500 basis points. If they're up 500 basis points, they're not going to gather enough, extra capital or, AUM. And if they're down, then they're definitely going to lose it. So their job is just to almost not make a mistake. And then so when you get a Tesla, and the problem about Tesla is that it went in with such a monster market weight, is that all of a sudden, if he didn't buy Tesla, he's short. And you're absolutely right that when we were looking at those Tesla numbers, everyone was talking about it. They were only giving you the numbers for the actual, let's just say fully indexed or like the S&P futures and the spiders and all those things, and everyone that's the Vanguard or whatever. But they're not including the huge bid that's out there from all the closet indexers.
Yeah. So let me just take my point to a conclusion. Way back, quite a few years back, when I got my CFA charter, the thing that happened in Toronto was they brought out some gray-haired guy, told you about the beauties of the industry and all the wonderfulness that was we had to look forward to. And they brought out some crusty old guy. I loved him. And he said, your job is just not to underperform so much that you lose your assets.
Right.
So there's a hell of a message to tell a kid who just got a CFA. But I think the problem is benchmarking. And I listen to a lot of podcasts. I read a lot of stuff. Only twice have I heard people ask the following question. And one was on a Huddle, and the other one was on a Grant Williams interview. Kev, you asked somebody, can you manage money without benchmarking? Right? And I have a different answer to the two that were provided. I say, yes, you can, but it's very difficult to build a business on it.
Okay, why is that? Explain why that is.
Well, because you can't build a business on it because it requires your investor. All you're going to do at the end of a year when you do your portfolio review is say you're up 5. And you're never going to say the index was up 15, et cetera, et cetera. And you have to have a client base that accepts and trusts that 5 was a good number, right? And without any comparative reasons. But if you look at a Canadian, and again, I'm referencing Canadian pension plans because for one reason or another, I've had to their annual reports are great documents to go through.
Oh yeah, they are.
Read the top 5. You'll see they all have different approaches and different objectives, but they all end up in the same place. They do not report a number versus an index, right? They say our number is this, our objective was this, our number was that.
Right.
Unfortunately, within each and every department, for compensation reasons, every group has a benchmark, and they perform the benchmark, and they're compensated off of performance to benchmark. So the underlying under the tarp is everybody's benchmarking and working towards that objective. But the big game up top is just get me a risk-adjusted absolute number.
Right.
So it's hard to communicate to investors without referencing benchmarks. And yet I think by doing so, you're pigeonholing yourself into becoming tied to benchmarking.
Okay. Another thing that you kind of push back on the industry is ESG. Why don't you tell me your complaints there?
Okay. So ESG, first of all, you break it down. There's no reason those 3 letters should be together. Whoever started this, I don't think they had any intent that it should be the product that it's become. So I'll take S and disavow any ability to speak. We should all live our lives to better the S factors.
Tell people what the S is, and like for those who aren't
social.
Okay.
Social. So make sure that your workforce is properly balanced and et cetera, right? All the issues we're dealing with these are so heightened these days. So I have no issue with S. Everybody should live their lives and invest appropriately. E, and again, I'm going to establish my bona fides. I ran a carbon portfolio for 5 years where we funded on behalf. I'm going to give a shout out. Our three investors were Toronto Dominion Bank, Bank of Montreal, and Stikeman Elliott. They are 3 carbon neutral companies. What they did is they threw money into our fund. Every year we would buy offsets, Canadian high quality offsets for them to their specs and definitions, and then retire them so they could claim carbon neutrality.
Okay.
So it's one of the most innovative things. It should be the thing I'm most proud of. And it was just a painful 5 years. And painful because it's extraordinarily difficult to communicate, and you become very jaded about the hypocrisy and greenwashing in the industry. So E, I swear nobody should take any credit for advancing E in your portfolio unless you've done everything you can do outside your portfolio. I think the direct transmission mechanism to improve the environment in any manner, be it climate, biodiversity, et cetera, is it has to come personally. If you want to affect industry, stop buying their product. If you stop buying their stock, it's not the same effect.
Yeah.
So I think I wouldn't tell anybody not to invest in E, but I say if you're really committed to E, do it personally. Then I go on to G.
Okay.
Sorry, go ahead.
No, I was going to say, I think that is the most well-articulated pushback against this that I've ever heard, and I completely and utterly agree.
Yeah. So G.
I'll just say the idea that we're trying to solve the problem of, let's just say energy and fossil fuel use by starving the companies of capital without changing the demand is just bonkers to me. Change the demand. Make it so people don't want to go. Change what people use. Anyways, I just here is all I can say to you about that. Okay, let's go on to G.
G. Okay, so I don't have bona fides. This is just me ranting. I think nobody should advance any initiative towards G unless the first thing that absolutely needs to be dealt with is executive compensation should not be tied to the beta of the market. And I know how we got here, and I think it's ridiculous, and I can't figure out how it's not been addressed. If you look at the market performance, I'm going to give you stats here. From 2018, which is the bottom of Powell's debacle, from 2018 through to 2020, the equity markets are up 55 points. 5 of those points are due to dividends. So that's 50 points.
Okay.
Of that, 58%, because there was a negative earnings drag, is PE expansion. So you've got executives tied to compensation. Their stock is up 58%, 50%, just because of PE expansion, to which they have no impact.
Right.
Minor impact, technically minor perhaps. But if you can't think that there might have been a bit of stimulus or rate effect to creating that bump, why are we paying executives off of that? It drives. So don't talk to me about G until somebody says, hey, wait a minute, whoa.
Yeah.
And then I can go off on options. But I know how we got to where we got to. It all started in the 70s with academic literature because managers started becoming professional. MBAs started pushing out professional managers, and it got implemented in the 80s, which is really before options took off. Options. I was an option trader in the mid to late 80s, and I tell you, there was nobody using options.
Right.
Again, the 8 years difference between me and you, Kevin, is shocking about how much you traded versus how much I was trying to get people to trade. But one of the fundamental principles of executive compensation is alignment of interests, amongst other principles. But alignment of interest is big. There's no alignment of interest with a call option.
Right.
So, I just can't understand how this hasn't been dealt with. It's not it doesn't come up in conversation, other than they post the top 5 executives, the ridiculousness of their comp. I'll give you a story in 2008. In 2008, Google incensed their employees, not just executives, with options. They realized that in the 2008 crisis, the options were a disincentive because they were below strike. So they reset strike.
Sign me up for those options.
So the stats are that from the reset through to year end, so this is just December 2009,
Yeah.
the average employee, this is documented, I'm not making the numbers up, the average employee made $100,000.
Right.
How's that an alignment of interest?
Right. Heads I win, tails you lose.
Yeah, I rant a bit on that.
No, it's all right. I'd love to hear it. Okay, last thing we're going to cover in terms of subject is corporate bonds. And we've seen the Fed buying them. Who knows how much they pushed it, but the reality is that spreads are, as tight as they've ever been? And I'd love to hear your view because you think that that's a disaster. Potential disaster.
Well, I think this goes back to my corporate bond trading days. I'm trying to find some numbers on this. The if you have a portfolio, pick a number, $1 million, and you go out and you buy treasuries, your yield is X, and you think that's just not satisfying enough. I think I can take a little bit more risks. So you start going out the curve, and you start taking yield risk, corporate risk. Well, the rough way I think of this is that if I buy 100 names, I figure out what the probability of default is going to be, and I figure out what the recovery rate of those who have defaulted is going to be, and I figure out what my net income is, taking into account those two variables, and I compare that against my risk-free portfolio.
Hey,
And
Phil,
it has to be
for
premium.
an equity guy, you're sounding like you know a little bit about corporate bond trading.
Well, when you've been blown up twice, you learn a thing or two. So I came about it through the hard knocks. But if you do that, there's two things. There's two variables here. It's the default rate, and default rate is an unknown variable, right?
Right.
Because you don't know, because you have to forecast the economic cycle. And frankly, if you can forecast the economic cycle accurately, what the fuck are you doing trading corporate bonds? So that's an unknown. But
Okay.
what is slightly known is the recovery rate, because we've been through enough credit cycles that you generally know what average returns are through recovery rates.
Okay.
And I saw stats that came out in the FTE just the other day, and I wrote them down, and now I can't find them. But the recovery rates of 45 different defaulted bonds from March through September of last year are off the charts low.
Oh, really? Oh, so
Right.
the previously kind of accepted amount that you would get has gone down this cycle.
Yeah, it's like I can't find the numbers, but the sub debt would recover sometimes like 20 cents on a dollar.
Yeah.
It got a penny.
Oh,
And the layer above sub debt, junior loans, normally gets 40. It was getting like 10 or 15.
and I guess that's just a function of more and more debt being piled on, and that's what you'd expect.
Well, you know what it is? It's Cov Light.
oh, yeah,
Is
and then the covenants, yeah.
Nobody needs to default until they are out, done and out.
Right.
So I don't think people who are extending out the credit curve are taking into account the fact that if you hit an economic recession, the recovery rates are just, the default rates are going to be higher than you thought, and the recovery rates are going to be extraordinarily low. And this was an article in the FT, so this is not information. I mean, it was not front page, but it was pretty dominantly displayed information.
It just doesn't matter nowadays, though, with the Tina going out there. People need to buy something, and they're just closing their eyes and buying it.
Well, so maybe the last point, or a point I can make, is people say, I have to do something. And to my point about if you're not benchmarking for a living, no, you don't.
Yes. Oh, I completely agree, Phil.
And that's a completely naive thing for me to say. I don't need to do anything.
No, and that's ultimately retail's greatest advantage, and they should take advantage of it. They can choose to, because you and I both know as professionals, you can't not participate. You lose your job. But you, if you're running your own portfolio, you can say, no, it's expensive. I can sit this one out.
And to your question about why can't you run a business when you're investing without benchmarks, it's because when you have to go to your investor and say, I didn't do anything last year, you have to allow that. You have to have trust that they'll say, that's the right thing to do. Thank you.
So,
and that just doesn't happen.
So my father tells a story of a fellow that used to work for him that went on to be a portfolio manager, and he was one of the top performing portfolio managers in his category. And the trouble was he eventually got fired, and he got fired because he went and he was like, let's say, a U.S. small cap investor. And he would go and he would hit these points where he says, I think they're going down. And he'd be like 80% cash. And he'd sit there and the stocks would go down. And he literally was consistently the top of the performance because he was losing less than everyone else. But they had to fire him because they're like, and he refused to buy it. He says, I'm not buying it. They're going down. And it was just kind of a funny story. And you're absolutely right there that and I guess that's a perfect example of the pressure from a professional point of view that we all face.
Yeah. So, Kev, I just dug up the stats on the recovery rates. Let me just give you a couple of them. So, loan investors, so secure, senior unsecured, so one level up from sub debt, received 5 cents on the dollar versus a normal 49 cents.
There you go.
During the Great Financial Crisis.
Wow. And that was during the Great Financial Crisis, which you'd assume would be, holy smokes, that's a huge deal.
Yeah.
No, that's actually I didn't realize that. Okay, Phil.
And so yesterday we all read the headline that corporate spreads are tightest in 14 years.
Yeah, but it's okay because you're gonna make it up if it ever goes default. It's like one of those jokes about I'm losing money, but I'm making it up in the volume. Okay, so Phil, I'm going to finish with some questions here. I'm sure you were ready for them. I won't ask you your what you would tell the your young Phil. I'll ask you, what would you tell someone that's young that wants to get into the business today?
Well, okay, I listen to many of your shows, as in all of them. So yeah, I know this question. So here's what's funny. When I told you when I was in my early teens, I was interested in the industry. And for all the reasons I would have been interested in the industry, I got to tell you, I don't know that I would be drawn to the industry today.
Oh.
Right? And that might sound like a harsh statement. I love what I've done and I love what I'm doing. But I think what the shiny object that attracted me then, I swear I'd be drawn to the crypto digital world right now.
There you go.
In the same event. But that doesn't answer your question.
No, that's okay.
I'm just trying to get back on side with the millennials.
No, listen, Phil, they've tuned out long ago, buddy.
In answer to your question, I would say, and again, when you're offering advice, all you're really doing is talking about yourself. I think if you're coming out with just a business degree, you better be the top class because there's a million business degrees out there. If you're coming out, I think you have to come out as a hybrid. You have to have something and something that makes, like you would be the story, the case study of that. Like not the best programmer, not the best trader, but the best programming trader at the time.
Right.
So I think you have to come at it with diverse skills. I personally like diverse backgrounds. I think you can learn the business, but you can't learn the classics. So go out, get a classic degree, and then flip yourself into the business world.
Okay, next question. Your favorite book? Investing book, sorry.
Yeah. So again, I would have, up until I turned to a macro guy, I would have said the classic Wizards, Reminiscences, and Popular Delusions.
Yeah.
I had the standard answer. I got turned on. I was already on my way to becoming a macro thinker. Lords of Finance, so really kind of put me straight as to which way to go. So I have a huge regard for that. The second book I will say is less obvious. I read a book, it just blew me away about how applicable it was. It's Kissinger on China. It's not even a new book. It's Kissinger detailing the Nixon overture to Mao back in the early 70s. And again, because it establishes the geopolitical China versus the West framework in a very, very positive manner. Not positive, but in a
straightforward and easy to understand.
Yeah. Not partisan, not biased.
Okay. Well, sorry, go ahead.
I have a third.
Oh, you're really ready for this question.
I'm a fan of reading. Sorry?
I said you're really ready for this question.
Yeah. So I'm a bit of a fan for presidential biographies. There was a really interesting book that was called Presidential Misconduct, which one from Washington all the way through to Obama detailed by historians, so it was written objectively, the misconduct of every presidential term. And there was a reason why that. I found that fascinating. But my third choice is going to be really out there. It's Herman Wouk, I'm mispronouncing his last name, wrote Winds of War and War and Remembrance, which are not finance books.
Okay.
But they're global geopolitical fascinating stories because it's a fictionalized version of World War II. And the big takeaway in that is, you learn way more about World War II and the politics and Hitler and Stalin and the unholy trinity between Stalin, Churchill, and Roosevelt. And these are all important things on my context of historical continuum. But the real takeaway was when you see how much warning there was, and those who heeded the warnings and acted, and those who didn't and got the obvious outcome, sorry, the eventual outcome. And I think that same context in the inflationary world today, all the warning signs are out there. And if you heed them, you position now.
I like it. I like it. That's a good not typical response. Okay, last question for you. Great traders, investors, born or made?
100% born. You can't make a trader, but you can make a portfolio manager.
Okay. Why do you feel that? I got to know.
Well, the trader is, you have to be born with an innate sense of risk reward, ability to understand risk reward probabilities and stats, not stats, but probabilities. And I come from a card playing background. My family loved playing cards. I went and took bridge classes one time. And in my bridge class was a base rate portfolio manager extraordinaire. And he could not grasp probability analysis that goes into card playing. And that made me realize he wouldn't stand a chance on a trade. Like, I realized you're either born with this ability or you're not.
He'd get chewed up.
Nothing wrong with that. But a portfolio manager is less that. And I think you can take a lawyer and make him a portfolio manager, but you can't take a lawyer and make him a trader if he can't play cards.
Well, that's interesting. Okay, so now, Phil, we're going to talk a little bit about what you're doing now and what you're trying to accomplish. So let's start with, you recently made a video, is on Real Vision. Why don't you tell people about that, and then why you made that and what you're trying to accomplish?
Sure. I have had this inflation theme, and it's been developing and stewing in my mind for a long period of time. And although the inflation story has picked up in the last year, I found it extraordinarily difficult to communicate to people my point of view prior to last year. I could empty a cocktail party in a second if I started talking about my point of view. And that changed last year, but I still had to figure out a way to articulate it. And so I created this video. I did it with Real Vision. They produced it, put it up on their site. I now have it on my own website. So you can go listen to it there. It's a 10, 11 minute view on inflation. And I think that inflation has to be handled in a certain way. You can't use the conventional thinking. You have to challenge conventional thinking. And I think there's a great investment firm that should be built, can be built, in terms of offering inflation protection to investors, because it's a total portfolio exercise. It's a creation of funds and products. It's active management, all under the guise of portfolio protection, but also still earning income and still participating in growth. I can't start that. My firm is basically always me, and I pull in partners when I come up with ideas. So the carbon fund was me, and I pulled in 3 partners.
Right.
Intellectual property financing, I've had a partner on that for a period of time, and on and on and on. And I'm looking for a partner, some 30 to 40-year-old investment professional who's tired of saying the same crap to the same people and realizes that they might buy into my thesis and say there's something better out there, and there's maybe a new investment firm that can be started, and to give me a shout and see if we can't figure out how to make a go of something in the future. I'm already positioned this way, as in my portfolio has been this way for a long period of time. And I think that there's a product and a service in an industry, a firm that can be created on this.
You want to be the next Gluskin chef, with a little bit of an inflation bent. Okay, so why don't you tell people where?
No, but okay.
Why don't you tell people where they can find your website? Let's start with that.
Oh, yeah, summerwoodgroup.com, summerwoodgroup.com.
Okay, and on there they can find the link to your video. Is that correct?
Yep.
Okay,
yep,
and
yep.
if somebody wants to reach out, and that 30 to 40-year-old new CEO that's itching to get out of his job at the big bank and wants to go start up a new fund with you, a new company with you, how can they reach you?
Well, I'm old school, so either on LinkedIn, which I loathe, but I'll respond to it, or just info at Summerwood Group. It would be real dead simple to figure out what my real address is, but use info.
Okay,
it'll work.
Terrific. Well, great. Phil, thank you so much for being with us. I really enjoyed it. It was great getting caught up and doing this on tape for once. You and I have drank a lot of beers together, talking about a lot of things. It's great to do it with everyone else listening.
Well, thanks, Kevin. It's been I really enjoyed it, and I'm a big fan. You, Patrick, and Lena do a great job on this. I'm a faithful listener, and it's great to be able to participate with you. I really appreciate the
Well, I'm
opportunity.
not going to let you off that easily now that you mentioned Lena. You had something that
Yeah.
you said before we started. You said to Lena that she is, and Lena, why don't you hop on here so you can get some. You there, Lena?
Oh, I'm here. I'm still here.
You okay? So what did you say about Lena, Phil?
Well, so again, I'm not sure if this is age specific, but Lena is the Robin Quivers to Howard Stern. Lena is to you and
That's
Patrick.
great.
And I say it with utmost respect because Robin basically keeps those monkeys in
I
line.
completely agree.
So
Robin's
don't go.
the best part of that show. I 100%
Yeah.
in this. The same with us with Lena.
Thank you.
Yep. No. Big fan of all three of you.
Okay. Well, thank you very much. Thanks for being with us today, Phil.
Yeah. Thank you, guys.
Take care. It's our great pleasure to welcome back to the show Will Thomson, managing partner from Massif Capital. Will, thanks for coming back.
Thanks for having me back.
So lots to talk about. One of the things that we talked about last time was Lithium America. And you kind of mentioning that there has been some developments there on the political side. I'd love to just get an update on that before we start.
Yeah, so I think last time we talked about how Lithium Americas was, at least in our opinion, sort of the strongest lithium junior out there, and was on the verge of bringing two huge mines into production with a lot of the offtake pre-sold, and it's a great situation. And now we also talked about political risk, of course, and now we've got this sort of amusing political risk problem that comes up in developing countries all the time when they're trying to build mines. The environmentalists have come out and sort of filed an injunction to try and prevent Lithium Americas from building their Thacker Pass mine in order to preserve the habitat for the sage grouse in Nevada. So the sage grouse is what's called a near threatened species, which is to say a species of bird that might be considered threatened with possible extinction in the future, which I think that probably goes for everything, right? We all are probably near threatened.
I actually feel these days that value investors are probably even more near threatened than the sage grouse.
Yeah, we may be suffering from one of these higher levels of threat. So they've had to, sort of put a halt on some of the development, and everything had already passed environmental regulations and everything. And now, we're going to be fighting this out in the courts, or at least I'm not, but Lithium Americas can. But it's the third or fourth case I can think of a critical mine and mineral, the other two being another lithium mine and some copper deposits, all out in the west coast of the United States, all having passed their permitting process and all getting their projects ground to a halt because environmentalists. And I mean, look, the environmental concerns are legitimate, but somebody's got to sort of say, well, what are we concerned with? Are we concerned with, the pollution that cars create, or are we concerned with the sage grouse?
Right.
And it's going to be one or the other, but you can't have all things.
I just Googled it. I had no idea what a sage grouse looked like. It is a pretty magnificent looking bird. It looks a little mean though.
Yeah. It looks mean. You can YouTube it and watch the male try to court the female. It's quite amusing. But again, what do we want?
Right.
And especially in the United States, where we've had the administration came out with a critical minerals battery related sort of strategy, and it was reliant on development of some of these copper and lithium deposits here in the United States that we have ready access to, and are high quality and great infrastructure, and we can do it sort of in a cleaner way than you can in a lot of other places because our regulation is high. But when it comes to a grinding halt.
So do you think this is just a short-term hiccup, and are you still is it enough to shake you off this story, or are you just thinking that it's just kind of a pause?
Yeah, so we didn't Stock traded down about 8% yesterday or the day before. I guess it was on Monday. We didn't use it as an opportunity to add to our position. We are still long-term holders. We think that this will get sorted out in the courts. And it might, it'll delay things a year. It'll delay things 18 months. But when you're talking about a 40-year asset, I think you got to expect some of these things to come up. But the political risk in the developed world remains nasty. And at least in my opinion, I'd rather deal with some of the political risk in the developing world, where you're talking with communities who are going to hurry up and make a decision, rather than engaging with court cases that can just drag on forever.
Right. Okay. So now the other thing you wanted to talk about, you've got a new name that you thought our readers or our listeners might be interested in. What is it?
Yeah. Well, so, we talked about a lot of obscure metals last time. We talked about tin. We talked about lithium, I guess not so obscure. I think we talked about copper, which definitely isn't obscure, but we talked about tin at least, which is obscure. So I thought I'd go in the other direction this time and sort of touch upon gold. Gold softened earlier this year. I think people were focused on the recovery. Yields staged a bit of a comeback, so investors weren't as interested. But I think gold found a nice sort of stable base and has rebounded a little bit. And so for those of us who are sort of thinking long term, I think there's a couple of interesting opportunities in the gold space. And the one I think is most interesting is Equinox Gold. So for those who aren't familiar, Equinox Gold is a Ross Beatty-backed sort of America's-focused gold miner. And Ross Beatty, of course, is the founder and was the chairman of Pan American Silver, the world's largest silver miner, serial mining entrepreneur, very successful. So really strong backing. So this firm started out 2018, no operations at the start of the year. They were producing no gold. They had one mine under development that they started to build. That year, they spun out some of their non-core assets, including a company called Solaris Copper, and acquired the Mesquite mine later that year. So by the end of 2018, they were producing 25,000 ounces. So again, nothing. 2019, they acquired the Aurizona mine in Brazil, which is a solid deposit. By the end of that year, they'd taken their 25,000 ounces to 200,000 ounces. Then they announced they were going to merge with Lee Gold. They listed on the New York Stock Exchange. They graduated to the TSX. In the beginning of last year, you were looking at a firm that was going to produce in excess of 200,000 ounces from 4 producing mines. They ended up producing close to 500,000 ounces from their mines. And then this year, they look like they're going to produce 630,000 ounces. Production growth of 32%. And then by 2024, with all the acquisitions that they've made, with all the asset brownfield expansion that they've done, they're going to go to in excess of 1 million ounces. So from 2018 to 2024, they're going to go from 0 to 1 million ounces of production.
Yeah, Beatty's doing it again, right?
Beatty is doing it again. And right now, their price to NAV is about 0.5. So these guys are selling at around $10 a share Canadian. Ticker symbol on the TSX is just EQX, and on the NYSE, I believe it's just EQX also. They got a rock solid balance sheet. They've got a great shareholder base. Ross Beatty owns 8%. Institutional investors represent about 50%, including the Sovereign Wealth Fund of Abu Dhabi, who has been in it from the very beginning. And throughout this entire time, they've just every step of the way, they've added value. And I think you sort of see that with some of the mines. So the Mesquite mine, they bought off the trash heap for $158 million in 2018. It's gone ahead and produced $139 million in free cash flow since they bought it. And they've discovered another 670,000 ounces of gold. The Aurizona mine, which they acquired for $160 million, has produced $175 million in free cash flow. And they've added 820 ounces of gold resources. The Solaris split, which 40% of which they retained. The shares on that are up 550%. So at just every step of the way, management has made sort of at the market acquisitions, or they've acquired mines that people thought were just sort of done, and have worked sort of exceedingly well on the geology and the operations, and are, on path to be the fastest growing gold miner over the next couple of years in what is, a strong gold market.
Right.
And so with the current share price at about $10 Canadian, we think it's got sort of a $24 valuation on it.
What do you think's happened in terms of the market? Because for a little while, the market seemed to be realizing it. We got a rally, post COVID, it went from $8 to 18, and since then it's sagged. And it's sagged along with all the golds, but it almost seems like it's really gotten sleepy and nobody cares.
Yeah, I think I think we got an initial pop that was really good, both on the story, and there was ETF. It got taken up into several ETFs. It got taken up into the big indices. We had a big inflow. Their liquidity went from $1 million worth of shares traded a day to $40 million worth of shares traded a day over, say, the last 18 months. So there's been a lot of activity. I think that some of the issues around their Los Filos deposit, and some concern perhaps around their ability to sort of properly bring all these mines together and operate well, having gone from no mines to now 7 operating mines, all of which are basically having work done on them in some way, shape, or form. I think that might concern some people a little bit. But I think, what we see if we continuously refresh sort of the shareholder base is a lot of the retail is now gone. Retail now represents, I think, only maybe 10% of the shareholders.
Okay.
And Ross Beatty's sitting there at 8, institutional is 50. You got some corporate, you got a couple of other things. So we've got really strong hands now that are holding it. So I think that this base here that we've put in at around $10, $11 Canadian is going to be strong.
Do they need any money? Are they going to have to do a raise at any point?
No. So that's the other thing. They are just, they got $350 million in cash. They've got a $400 million revolver with $200 million of it available. Total liquidity, of $500 million, and they got a term loan for $100 million. So they don't really have much in the way of debt in the grand scheme of things. So they're in strong position.
So you touched briefly on Ceres, and I'll give you just a little side story here. One of the smartest young salesmen, and probably the best salesman on Bay Street, he he said, just buy the Ceres and forget about it. And Ceres, for those who don't know, is I guess they took the copper assets and put it aside.
Yeah.
And he told me that, and I swear to God, it's been just one of the best performers, just chug, 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 chug every day. It looks like Bernie Madoff is behind this thing because it just seems to climb every day with very little volatility. I wish I had listened to him more. And if you're listening, Winston, thank you for that little heads up, because it's been a great call. Have you looked at it? Do you have an opinion about it, or is it just it kind of adds to the kind of allure to the Equinox, given that they still own a portion of it?
Yeah, I mean, we've looked at it briefly, not in a while. I think we looked at it when we first bought into Equinox because they had already spun Solaris out. It probably was a mistake on our part also not to pay closer attention. They've got a lot of solid copper assets throughout South America. They're all pretty early stage. I can't really speak to whether the stock has run ahead of itself or not, though. So
right.
I know some of what they're doing is very early stage, or at least it was a couple of years ago. I don't know how far advanced it is at this point.
Right. For those who are interested, that one only trades on the Canadian Stock Exchange, and it's SLS, Sam, Larry, Sam. But it does, listen, it has gone a long way. It's, gone from $4 to 12 in no time. Yeah. Okay.
I wouldn't be surprised if, just the way copper's been going and mining stocks, the way they trade, I kind of expect copper to do a pullback here. I would expect something like Solaris to pull back pretty significantly on a copper sort of a move.
Okay, so why don't we touch on that? Why do you think copper is going to pull back? Has it just gone ahead of itself? Too many people bullish, or are you concerned about the recent developments in China?
Yeah, I mean, I think it has just the move has been huge. It's been tremendous, and we definitely are quite positive on copper in the long term. But over the next couple of years, you've got some good mines coming online. The Kamoa-Kakula mine, Ivanhoe's, giant world-class copper mine in the DRC, just came online. It's a huge producer. It's going to upsize again over the next 2 years. There are a couple of other deposits that come online. And so while there is undoubtedly a lack of good deposits that can be brought online relatively quickly, sitting in the cupboard, if you will, of the copper miners, there are a couple of deposits coming online that are really going to make the supply-demand imbalance. It's going to even it out a little bit for a couple of years before we really hit a long-term supply crunch.
I would argue as well that might coincide with the demand side that is probably being a little overextended in terms of the amount of bulls out there. I don't know about you, but like the kind of idea that we're into a secular bull market in copper seems to be probably one of the most popular, trades that everyone has on.
Yeah, I mean, I agree with you on that. I'm always going back and forth with it. I have this sort of contrarian right, contrarian wrong sort of idea where you can be contrarian wrong and be contrarian right. I worry about everyone in the copper space, but I do think it's one of these contrarian wrong opinions if you take the opposite side.
Oh, what do you mean by that? Just explain that.
Well,
You're
like
saying
you can
that.
so I mean, me personally, if everyone is saying X, I am almost inherently going to be like, no, it's going to be Y.
Right.
But sometimes being contrarian, you're being contrarian for the sake of being contrarian. And that's contrarian wrong.
Right.
And in the market, we care about making money. We don't care about being right. So whether I'm, right about the contrarianness or not, I don't really care about. And yeah, everyone likes copper. Everyone sees it. I think that it's a very difficult metal, in my opinion, to invest in successfully, but it's an easy metal to get access to. And so everyone piles in. I think over the long term, it's still a bull market. Although admittedly in the short term, I think we may have a pullback.
Right. Yeah. The other thing that people need to remember is in bull markets, in the greatest bull markets, those are when the most violent corrections occur.
Yeah, absolutely.
And it's the opposite in a bear market. Bear market, you get that constant drip, drip, drip with then these screaming, 10-20% rallies that then just disappoint again. Whereas it's almost the opposite in bull markets. So we get, the rise, then a very quick, sharp break. And next thing you know, it just cleans up and we go higher again. Who knows? I'm a little like you. I suffer from that desire to fade the masses no matter what. And I've been working on it. Maybe we could start a support group. You and I, we're not. We could call it something like the masses aren't always wrong. Okay. The other kind of development that's occurred this week is that we saw the uranium stocks get hit. And obviously, it was kind of from rumors or reporting that there was a China leak. I think you have some insight into that. I'd love to hear your opinion.
Yeah, so I'm going to skip trying to pronounce some of these names. There's just because I believe it's called the Tianjin nuclear power plant.
Oh, it sounds pretty good to me, man.
Yeah, well, I'm sure someone will correct me. So this is it's kind of interesting. So China obviously has looked out at the world and looked out at what they're doing and said, we need to build a lot of nuclear power plants. And so a couple of years ago, I mean, at this point is probably 10 years ago, which in the world of nuclear power plants is a short period of time. They went out and they said, we want a reactor of every kind. So they bought reactors from Canada, the United States, France, etc. So this reactor, this Tianjin nuclear power plant is a reactor built by the French energy company EDF. It's called an ERP reactor. And basically they noticed that there was what appeared to be perhaps some radiation leakage. And so all the headlines said radiation leakage. And this is sort of classic reporting on nuclear power. Radiation leakage, everybody panic without any sort of effort made to understand the context of the radiation leakage or how significant it is. And I talked with a couple of people about it over the last couple of days, and it turns out that the radiation leakage, you live in Denver, Colorado, you're going to get about 10 times the amount of radiation on a daily basis from just living in Denver, Colorado than you are from this current radiation leak.
Why is that? Because you're closer to the sun because it's higher up?
Altitude.
Yeah,
Yep.
okay.
Just altitude, which is to say, you're going to get more radiation probably flying across the Atlantic from New York to London. There are a whole bunch of these sort of classic examples of where you get a ton of radiation and you don't know. But, this leak is just, it's probably pretty common. It used to be very common in the source of the leak is probably the fuel rods is basically what it comes down to. And the fuel rods are filled with pellets, and these pellets expand and contract with heat. And every once in a while you get some xenon gas or some of these noble gases, if you will, that don't react to much leaking out. And we used to get them in developed world reactors all the time until they changed some of the regulation. The regulation for nuclear is always just driving towards this zero accident, zero risk sort of level, despite the fact that, again, this radiation leak, you live in Denver, you're getting more radiation. There's nothing here to worry about. Obviously, they need to be concerned with it, and they need to look into some of the engineering and what's going on in the fuel rods to make sure everything is squared away. But the headlines just don't sync with the story.
Right. And so now, did you take this opportunity to buy any of the names? And if so, what are the names that you like on the uranium side?
Yeah, so we already have a full position in Kazatomprom, and so we did not add to it. We really like Kazatomprom. What we really like about Kazatomprom is that they are paying a healthy dividend. They are the world's largest uranium producer. They are China's biggest supplier, and China's sort of the biggest growing market. And while you sit there and wait for the uranium price to move, which a lot of people have been waiting for about 10 years now, you get paid this 7 to 10% dividend.
Right.
And from our perspective, if you're looking to invest in a uranium company and you don't want your investment to be based solely on sort of an expectation for a movement in the price of uranium, which we think is sort of the right way to approach commodity companies, then, sort of Kazatomprom is your place to be. Everything else, uranium prices are going to have to really start to move for you to really see some pop.
Well,
in terms of...
Oh, sorry, I didn't mean to interrupt. I wanted to just jump in, though, in terms of one of the problems that I think that some uranium investors have is that they remember this great bull market of whenever it was back, a decade ago, and they go and they buy the most levered, crazy, piece of property that, there's lots of, uranium in the ground, but the reality is that it's not going to be mined. Yep. And we're ages and ages away from that. And I've found it kind of fascinating how you see, even though uranium is still trading under the cost of production, is it not?
Yes,
in terms
absolutely.
Of that people,
except for Kazatomprom.
Right. Okay. So that people are still going and buying the most speculative, things. Like, to me, it seems like a little bit of a paradox, or I don't really understand it. Do you foresee those people, like, is that just a trading sardine? Are those people going to eventually get hurt buying those kinds of things?
So at the peak, and I'm sure a bunch of your listeners have already heard this, at the peak of the last uranium cycle, there was like 500 uranium miners in Canada. And now there are, 30 or something.
Right.
So a lot of that 30 that still exist have the best deposits that fell out of that last cycle, but a lot of them also just have crap. I think depending on how selective you were in your juniors, you'll be fine. If you have invested in Denison Mines, which is a Lundin-backed group, if you've invested in NextGen, which owns the Arrow deposit, which is one of the world's sort of great uranium deposits, you're probably going to be fine.
Well, can we talk about that? Because someone told me that deposit, the next gen one, which is the darling of what everyone loves to trade, and when they're reaching for it because it's a world class asset. Someone said that if they actually went and produced this, we'd have more than enough uranium for like the next 20, 50 years or something. It's that big.
Yeah, no, I mean, there's no shortage of uranium. Like there's only a shortage of interestingly, just like lithium, how there's sort of this intense processing supply chain, and there are all these sort of bottlenecks in it throughout.
Yep.
Uranium bottlenecks are not in sort of actual availability of uranium. There are plenty of uranium deposits out there. Arrow being sort of one of the largest ones. We don't have a shortage of uranium, and I myself would rather be out of uranium when Arrow comes online than in uranium, just because, again, it is a relatively niche market and theoretically easy to swamp.
Right, and does that next gen mine, this Arrow, does it ever get developed? Or because
I think it does, but I don't think it does until you see. I mean, it's a bit. I don't remember exactly what its costs are, but I think it's $1 billion project. So I don't think it gets developed until you see, say, 6 to 12 months of $50 uranium. And, that's sort of the situation we are trying to avoid, right? Like we've followed uranium for 10 years and intensely for 5, doing nothing until Kazatomprom came around. And again, that's because we love exposure to a commodity price tailwind, but we don't want our investment to hinge upon a commodity price tailwind.
Okay. Right.
And so
the margin of safety kind of deal.
The margin of safety. And so I think the uranium space has gotten even harder to invest in because a lot of the stocks have moved.
Right.
And so because they've moved, it's gotten more expensive with no actual change in the situation or the likelihood that they turn these things on anytime soon.
Since we last spoke, I believe that Sprott has gone and bought the Uranium Participation Fund. And for those who don't know, this is a closed-end fund that actually invests or owns uranium, because it's difficult. Not everyone's allowed to own the physical uranium. And the thinking behind this is that Sprott is going to be a lot more keen to go and actually keep the NAV, like the net asset value, closer to the actual price of uranium. And they're going to work harder to make it so that it becomes a more liquid, investable asset. And the thinking is, and also listed on the New York Stock Exchange, I believe, and the thinking is that if we do that, it'll become that extra supply that we've seen in the marketplace will get soaked up by investors, because up until now it's been difficult for investors to buy that. Do you buy that, and do you think it's a game changer in terms of for the uranium story, or do you think it's just kind of the uranium bulls getting excited about something that's not really that important?
I don't think it's a game changer. I do think it's important.
Okay.
So, I think, especially with something like the uranium market, I think part of the issue is that you've had all these investors who think that there's a bunch of things that are game changers. The reality is all of the things that people have seen have been important, but we're just taking one step at a time. And if you take one step at a time long enough, you eventually get wherever you're going. But these are just one step, and I think we've already seen a lot of uranium producers, Cameco, Kazatomprom, UEX. A lot of these guys have already gone out into the market and bought uranium
in the spot market, because it's cheaper for them to do that than mine it.
Yeah. You have Yellow Cake in London, which just holds physical uranium and issued a bunch of shares recently in order to buy more. Of course, you've had Uranium Participation Corp. So these entities have existed already, basically. They haven't necessarily executed their strategy as well as they could have. So does Sprott have the capability set and the track record to perhaps execute the strategy better of sort of stockpiling uranium and soaking up some secondary supply in the spot market when it's cheap? Sure. Absolutely. I'm sure running a sort of physical commodity ETF like that requires a skill set that, some people have and some people don't. Is it going to be a game changer? No. Is it going to provide a bunch of interesting and value-added liquidity to the market, perhaps.
Hopefully it soaks up all that excess supply and we get it at least to the cost of production. I think that would be a huge win.
Yeah, that would be a huge win.
Listen, Will, it's been great having you. Why don't you tell people about your firm, where they can find and where they could reach out if they want to learn more?
Yeah. Massif Capital is long short equity fund. We focus on energy, basic materials, and industrials, and sort of the energy transition, low carbon economy, and sort of we are ESG investors for those who don't care for ESG or think ESG is nonsense. So that's who we are. You can find us at massifcap.com, on Twitter at massifcap. We distribute a fair amount of research, so feel free to come to our website and sign up.
And I really encourage people to go. You are actually very, very kind and giving in terms of research. You pass it all out there. And for those that, like me, that aren't very good with the spelling, it's Massif is MASSIFCAP.com. Will, it's been a pleasure having you on again, and we look forward to having you back.
Great. Thanks, Kevin.
All right, Patrick, it's time for Talking Charts. What do you have for us this week?
All right, normally we do a top three. We were not planning on doing a talking charts, but then we realized what happened after the Fed, and we were like, how can we not do a talking charts, right? Let's, lots to talk about. What a crazy end to the week, isn't it?
Oh, well, I guess Thursday and Friday, two really big days. Actually, Wednesday, it started Wednesday with the Fed. Big surprise. Not a lot of people were expecting it, and it's really thrown the market for a loop.
And actually, let's just jump right to it. We'll talk equities and other things, but let's start first with the dollar. Wow, it just blasted off on that hawkish tilt. That 89.90 support along the downside of dollar index was a 5-year low. Like when we put the weekly chart up, that was where the lows in 2018 came in, and basically we haven't seen a number below this 89.90 support since 2015, and we were looking as to whether that support line would hold, and the Fed came in to the rescue almost, and the dollar has now kind of worked itself way well off of that low. The big question really in my mind is this just a short-term reaction off the low that's just a bounce off a support line, or was this sufficient of a shift to cause order flow, like not order flow, but capital flows to shift to make the U.S. dollar actually shift to a bull trend? I think 1 or 2 days is insufficient time to be already calling for a bull run on the dollar. But what a strong start to this. Any comment on it?
Well, the one comment I'd make is that if we do get the dollar continuing to rip higher at this rate, it's going to cause a lot of problems in the markets. And that's the one thing. Just be on the lookout at this pace. If it continues, it'll eventually cause problems in the financial markets. And that's one of the big things that I always find about currency. It's not the absolute levels that matter; it's the pace upon which they change.
The rate of change, and it will be interesting because again, there was what we just witnessed in the last 24, 48 hours was a shock, right? It just came in, and the reaction is quick, but usually. If it was an overshoot, things kind of dissipate, calm down, and then mean revert. One of the biggest things to watch next week is whether or not there's continuation of this trend, right? And,
I would say that, Patrick, you finally get your chance to say that the U.S. dollar is one of the most important things to watch next week.
Yes, and rightfully so. I was just a month early, 2 months earlier. Anyway, let's talk some of the big ones. First of all, interestingly enough, that crypto isn't moving at all on this. The asset that shall not be named has been relatively weak in price action. Nothing. To be honest, I was expecting the bulls to be able to muster up a move back toward 45,000 on this asset that shouldn't be named.
Really, because I actually would argue that it's compared to gold, it's turned out to be quite a store of value. And don't mistake that as a bullish kind of argument for me. But, Peter Schiff and his son, the long-running feud, looks like his son might be more right than Peter Schiff.
Oh, my God. You're just overreading a couple of days of price action. Jeez, you're killing me, dude. Well, why don't you look at, you're cherry picking. Well, how is that any different than looking at the performance of the last 3 months? And I would show you that Bitcoin's down 50% while gold is up. You're the worst, dude.
Patrick,
okay, so
you're not going to get me to defend Bitcoin,
right.
so don't even try.
All right, so I wanted to touch on crude oil here. and just obviously a little bit of a reversal off of that 70. Like for me, the 70 to 73 zone was a target zone that could have put in a short-term swing high on oil crude. Not a major shift of trend, but I was not as I was watching this level. We obviously have a reversal. Well, today, oil's right back up. This is really important. Like usually, what we see when a market turns is it starts to shift to distribution. This morning's rally in crude, what I'm going to be watching into Monday or Tuesday is, does it manage to muster up a rally all the way back to the previous highs, or is this today's rally sold into? The price action into early next week is something that I think will really decide whether we're a swing high in crude oil's in. The other thing to point out here, Kev, is that crude oil has been the only real commodity that's had any strength in the last month. Right, and ever since that high CPI print that came in the other month, a lot of commodities have put in their highs and have been selling outright. And to me, because crude oil is so big, it's actually kept, like for instance, the Bloomberg Commodity Index has held up like a champ relative to what some of the different individual commodities have been doing. And that's largely because of its weighting into oil, which has been the only commodity holding up. And when we really look across the entire commodity complex, like whether you're talking copper with an outright breakdown in the last few days, even gasoline futures failed, the RBOB failed to make higher highs to confirm crude oil. But then you go to look at the grains, like, look at the way the beans have broken down. Like this is a continuous chart. There's probably a roll in there, but still a massive breakdown in the beans. And look at the Eiffel Tower formation in lumber. Like as fast as it went up, it went right back down. Isn't it's extraordinary, right? And so to me, commodities have been outright in a bloodbath, and oil is disguising it in the broader indexes. And this is why watching whether crude oil bumps its head and actually starts to roll over is one of the bigger macro things to watch.
I don't disagree with you that it's something to watch, but I'm not, as usual, I'm not going to be as bearish as you seem to be, kind of reading between the lines. And the other thing I will tell you, Patrick, is for those that are willing to go and catch some knives, I suggest maybe have a look at lumber. I think if you were brave, you might put your hand out there. Now, listen, I'm missing a lot of fingers, so you got to realize that this is not going well. But, I think for a punt, you buy the lumber in here.
Look, anytime something is as oversold as this, it's the equivalent of even like Bitcoin off its low a month ago. There's going to be a reaction. Lumber back to 1,000 or 1,100 on a reaction would be actually a very natural dead cat bounce, just a reaction. But anyone that's holding out for a return back to its previous highs, I think that's wishful thinking. But a reaction.
I'm not trying to say that. I'm just saying for a trade, I think it works.
For a trade, for a bounce, I'm with you on that.
Well, then it's never going to work. It's going to keep going. Don't buy it, folks.
But it's okay. So let's talk bonds. And you were the one on top of this, so I'm going to let you do some of the talking here because this is sort of your trade. But the move was the flattener, right? Which is the belly of the curve. The 5-year yield has a pop, while as you go out in duration, the 10-year kind of right back down to 145, and the 30-year yield outright breaking down. And where the real breakdown in this entire story is in that 530s yield curve, which basically wiped out 6 months of steepening in 3 days.
It's actually getting to the point where it's the pace upon which this is occurring is scary, and it's
is this the canary in the coal mine? Like, when I look at this chart, it seems something broke. I
don't disagree. For the first time, I'm actually worried about stocks, and it's mainly because of the yield curve. And I think that this is a big deal, and this is giving you some signals that something's
something. A lot of people don't watch this, and those that do, like a move of this magnitude. Like, we are back to November lows on this 30-year.
The other thing I would just kind of interject there, Patrick, is that you were going through all the different charts, and you were showing how the 5-year yield had risen, and everyone always kind of gives me guff when I push back against saying that a hawkish Fed can cause the long end to actually rally in price and go down in yield. This is a perfect example. We just had this. What's happened is that the Fed has gotten more hawkish. They've raised rates, and contrary to what everyone believes, instead of the long end actually going down in price, it's risen. Yeah. And the reason is because if you think about it, if you're a long bond sovereign investor, apart from default, which you're going to say never happens in the U.S., your biggest concern is inflation. And the Fed has just come out and told you that they're going to be tougher on inflation. So of course you're going to get a stampede into the long end.
So I don't have a chart up of the break evens, but has it gotten properly hammered? And
the break evens have gone down, and for example, if you go look at the 5-year tips, the real yield there for sure has exploded higher, and the break evens have fallen. They probably haven't fallen as much. Let me just look. So let's just take a 10-year break even and pull this up. Let me just get it here. I think that it hasn't been as bad as I might expect or be worried about. Let's just look. It's gone from 260 down to 223, but it's really in the curve shape that you see the real amount of pain. And obviously there was a lot of people hiding in that steepener trade. A lot of people.
It was a crowded trade, but but it's amazing to me how fast the crowded trade just got wiped.
And I think that's really the true lesson for this is that to show when a trade gets crowded, how quickly it all of a sudden can get cleaned out, and it's used to take weeks for this to happen. This is just going faster and faster in terms of it just kind of creeps along, and then all of a sudden, boom, 3 days and it's over. Now, I do think that the 530s today is the low, and I've probably goochered it now. But to me, it feels like
well, listen, after going all the way back to the November low in 3 days, it's kind of already been baked into the cake. I mean, this for sure.
Now watch, it's going to get worse. But it just feels really panicky.
Well, even but even if it gets worse, let's be realistic. The damage is rear view. Like, I mean, it could always get on the very short term, like over a 6-month trend. Yeah, it could get worse. But I think for a 3-day adjustment, this is an overshoot on the downside. But anyway, let's move on and talk equity markets. Very toppy, rolling over. But this is, again, a sector rotation story because obviously cyclicals and financials all getting hammered. And surprisingly, the FANGs are holding up just fine. Like, look at the way stocks like Apple are holding up, Microsoft holding up along its highs, like or you take an Amazon pushing right back to their highs. Even Tesla and ARK aren't selling. You're really suddenly you kill the inflation story and you put on some sort of chance that we're going to see a disinflationary impulse, and suddenly the FANGs are back in fashion this quickly, right?
Yeah, you said surprisingly. I don't think it's surprising at all. The long end is ripped. Just ripped. Like, just go pull up the long bond and put it beside FANG. It's going to look like the same chart.
I mean, just look at the way the TLT. We'll use that as a proxy. But like,
and then the thing's ripped. So of course everyone's gone back into tech. It's been a huge stampede back into tech, and that's not only has the trade on terms of the steepener and selling all your commodities and selling your coppers and stuff like that. Not only have investors abandoned that, they've also gone in back and embraced the old things that won. They're rushing back into, as you mentioned, Tesla, Apple, Facebook, whatever these things are, the long-term, long growth stocks with the longest duration, because they've all, assumed that rates are headed, that was the top in rates.
Right.
The real question, I think, is, was that the top in rates? Was that the top in the steepening? And I guess we'll have to talk about that another day.
We will. Anyway, that's enough for talking charts. Let's move on. Kev, it's time for skin in the game, bud. And you know what?
We're recording this a little early, just so everybody knows. We're doing this on Friday at lunch because we have some.
We just have some scheduling things.
Yeah, Alina has to, get home, and we don't want to be keeping her in Florida longer than she has to be. Although she probably would like that. So let me just. We're going to actually go and declare a winner ahead of time. And who knows if it's going to be...
we only need the winner to determine who is going to make the bet.
Oh, we're going to actually...
Right? Like, wherever it closes, if it pivots. But right now, I mean, you've got almost 30 S&P points in your favor with, 4 hours to go. I think on balance of probabilities, you won. But I mean, there's always a chance that there's an end of day move. But at this stage, it looks like I mean the tight range was working right up until Powell.
Listen, the Fed really threw it for a loop, and
Yeah.
I must say you got to thank Cuppy for this one.
Well, listen, I actually didn't.
You would have
mind
chosen
his
it
bet.
anyways?
I would have probably chosen it anyway, yeah.
Okay.
And so you chose a tight range. Look, on the gamma pin likely was going to keep it in the range, right? And it's just the shock on the market and the intermarket freakout was just too much, and the S&P is just succumbing to that pressure, right?
Okay, so let me tell everyone about this. Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by next episode, and the currency for the wagers is as follows. A Duke and Duke, which is a crisp $1 American bill. A pint of beer, a burger bet, a pitcher, a case of beer, affectionately known here in Canada as a 2-4, a bottle of wine, a box in Patrick's case, and then finally the big kahuna, the steak dinner.
Volume over quality.
That's right. That is how you choose your wine. Most people don't look at the price per unit like Patrick does. He's like, you know how they divide the per grams or whatever, they do that, and I don't know if they actually do that at the liquor store, but Patrick takes out his calculator and figures it out that way. The winner of the bet is obligated to create a new bet for the following week. All wagers settle in full, and there will be no netting of positions. Okay, Patrick.
Let's do it, bud.
I've decided I'm going to do bonds. Too
All right.
exciting. I was going to do the TLT, but I want to do the real one. Let's do the future.
The ZB?
Yeah, we'll do the ZB. Is ZB
This is the continuous, or you want me to go to a specific?
No, we'll do September.
Okay.
Okay, so ZB is up 157, almost $5.
So right now it's 160 and 26 seconds.
Right. Now I'm going to give you a one touch. And the one touch is going to be 162.09. Does it touch it or not next week? Anytime. Because
Yes,
that's why
I'll take the touch. I'll
good.
take the touch.
Great. Awesome.
Great. Oh, you wanted that.
Yeah, okay. Great. I was trying to figure out the 162.01. One
No,
touch.
09 you said.
09. Well, even
Oh, no,
better.
give me
You're
01.
No,
Oh,
you're
01.
talking yourself out of it. 09 sounds good to me.
But
so
you
what
did
do
say 09, didn't you?
I don't know. I can't remember.
You
09
did
it
say
is. 09 it is.
Yeah, okay.
I'm going to start with a pitcher. Question is, do you want to go up from there?
No.
Okay.
I'm
pitcher-
happy.
the
I was hungry for a burger, to be honest, but pitcher's fine by me.
Yeah, we need to get lots of pitchers.
Yeah,
For
I did end up using a few of the pitchers
Okay.
for the Miami piss up, so we need to reset the
Okay, well, then let's
stockpile
definitely
for
do a
the
pitcher.
Toronto piss up.
So there you go, Lena. It's 162 and 9/30, one touch next week. Okay.
All right, okay, good stuff.
Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow on Twitter at the Market Huddle. We're there every day. Lena gets tired just talking to Patrick and I. You can listen to the Market Huddle on all of our networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our latest charts and visuals. And while you're there, please like and subscribe to get our latest content. And please, if you could, rate us on iTunes. You know why. Patrick, where can we find you?
You can find me on Twitter at Patrick Ceresna, and you can also follow me at bigpicturetrading.com. Kev, where can they follow your fantastic newsletter?
Oh, gosh. Well, I don't know about the fantastic one, but you can check out my regular one at macrotourist.com, and I can be reached on Twitter at Kevin Muir. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in, and the after show will be back next week. For this week, we're going to let Lena get home and get on the road towards getting home, and stay tuned for a better after show next week.
All right, thanks, everyone.